Shares of Lemonade getting a pop today. The move coming after the company acquired Metromile. It's a pay-per-mile car insurance company. Shares may be up today, but year to date, they are still down nearly 50%. Joining us now in a Closing Bell exclusive is Lemonade CEO Daniel Schreiber. Welcome back, Daniel. Good to see you.
Great to be with you.
So why now? Why is now the time to double down on auto insurance when the auto industry is facing some real challenges with supply chain and inflation and potentially softening demand?
Yeah, there may be softening demand for the larger players, but actually from where we're standing, we see unlimited total available market. This is a $250 billion market in the US alone, and we have none of it. So for us, already having homeowners insurance and renters and pet, we're getting customers banging on our doors asking to bundle it with car insurance. We have tremendous pent-up demand. Our customers today spend over $1 billion on car insurance. They just couldn't spend it with us. So for us, it's a huge unlock of value that we've been working on for quite a while.
Piper Sandler expressing a little bit of skepticism on the deal, saying that as a standalone company, they were challenged, the company you're buying, several headwinds. And in particular, pay-per-mile pricing remains inherently challenged, according to the analysts, with elevated driving patterns coming out of COVID and consumers turning to traditional policies. How do you respond?
Yeah, we didn't buy Metromile as a going concern. We really bought it for some of its core assets. We launched 6 months ago our own car insurance, Lemonade Car. And Lemonade Car is, I think, the most customer-friendly, loved insurance product out there. But newcomers into this highly competitive market are disadvantaged. We're pre-scale, and without scale, it's tough to succeed in this industry. And we don't have our own data. And data really is what this entire industry thrives on. Metromile had exactly those things. They had perhaps the best, most nuanced and highest quality, most textured data of any car insurer out there. For 10 years, they've had highly, really intricate sensors, highly sensitive sensors driving around billions of miles of Americans driving around over 500 million road trips. And that data is tremendous. They have really world-class data scientists who have been working for years to distill those into models that can predict claims per mile driven at a level of precision that the rest of the industry really wishes they had. So for us, it's about bringing those two together, already having some of the best tech, best branding, best product from a consumer perspective, marrying that with the best data science, best data archives that are out there. That should allow us to leapfrog a lot of the competitive dynamics out there and move from being a disadvantaged newcomer to being really being a player with a competitive advantage that should endure.
So, Daniel, you're still talking about growth. You're a growth company, all the runway that's ahead of you as a newcomer. You know, the stock has had a really rough ride. This was a stock that was, what, 160 or so at the beginning of last year. It's now down to the 20s or so. Have you had to refocus the attention on profitability, on cutting costs? How has it changed what you're trying to do there?
So, yes and no. Clearly, when the entire stock market, let alone growth stocks, have been hit more or less in proportion to what we were hit, it's hard to take it personally. So these are greater forces than our company. These are not reflections of performance of the company. The company has been public for 9 quarters and has hit or exceeded expectations each time. So we've really been focused on doing what we said we were going to do, and in large measure have been able to do that. The stock in due course will reflect that. That said, costs of capital are driven by stock price. So as our cost of capital increases, we definitely want to marshal our resources to make sure that they last the distance and enable us to keep doing what we're doing. Notwithstanding that, we are seeing something like 70% growth this year and peak losses. So we are seeing ourselves at the point of turning that corner towards profitability. Within a few months, we'll start seeing declining losses all the way through to profitability, all the while seeing robust growth, because this is an industry where scale matters, and you have to keep growing if you want to be successful in the insurance space.
So profitability within quarters, is that what you're saying?
I'm saying that within quarters, we are turning towards increasing profitability. So you'll see our losses peak this year, and every successive year, we will be on a downward slope in terms of profitability, of losses towards profitability. We do still have $1 billion in the bank. We are well capitalized and should be able to manage that process reasonably well.